Welcome to the road to growth, success of an entrepreneur.
We raise water.
Learn firsthand from successful business owners and create your own path to success.
I'm going to show you how great I am.
It's time to hit the road to growth with team lead of the Enriquez Group, Realtor Vinny.
Howdy, Road to Growth listeners. Today I have Heather Dreves. She is the co-founder and director of funding at Secured Investment Corp. Thank you, Heather, for being here today.
Absolutely. Thank you for having me. It's exciting.
There's a lot of moving parts with your company. I mean, for the quick synopsis, and Heather's going to get more in depth on this, but the quick synopsis is it gives people an avenue to invest their funds without being the person that takes it all on their shoulders. And I've had on the podcast previously investors that take it all on their shoulders. Yet maybe you're just looking to dabble, put your toe into the market and kind of really fill it out. This is more the avenue. And then also, if you are going to take it all on your shoulders, Heather can help you out too with some private funding. So Heather, why don't you walk us through a little more into what you guys do?
Yeah, absolutely. Well, we're kind of a unique and interesting company where we are here to help and assist people to grow their wealth. And so it's pretty exciting because we actually have the opportunity to help very active real estate investors. And then the side of the business that I really focus on is my clients and other people that are looking for a passive path to wealth through real estate. And so I think, where we've been able to solve people's challenges is, a lot of people want to get active with investing in real estate, but they either don't have the capital or they don't have the time. A lot of my clients are very successful professionals. They're self-employed. They own their own businesses. And as we all know, if you're an active real estate investor, it takes money and time. And so we've been able to actually give people the ability to still invest in real estate without having to commit a lot of time to it and a lot of capital. And that's really through our real estate funds that we manage and the notes that we sell. We obviously still cater to our active real estate investor, but not everybody wants to deal with tenants and toilets and subcontractors. And so, we feel like we should be able to offer that to just about anybody at any level, meaning, if they have $1,000 to get started or the time, we have the opportunities available to do that. So we're excited to be able to really cater to just about anybody and help, anybody solve the solution that they're trying to accomplish through investing in real estate.
So on the low end, you guys will take $1,000?
Yeah, so it's pretty neat. I came on board 10 years ago and we developed this real estate fund. And as anybody knows that's invested in real estate funds or has managed them, most of the time you have to be what's called an accredited investor to actually even invest money into them. And we've never really thought that was right, but obviously we want to be compliant with the SEC. And so we've always followed the rules. And about 4 years ago, through the Jobs Act, they changed a lot of those requirements. And as an organization, we have a passion for, really giving the opportunity to anybody to invest. And so we opened up what's called a Regulation A+ fund, and anybody can invest in it. You don't have to qualify as a high net worth individual. And we set the minimum as low as $1,000 because we do believe and we're passionate about the fact that you have to start somewhere. You talk to these people and they think that they have to have all this capital to start investing. You just have to start somewhere. And so, we have a fund that has a minimum investment of $1,000. It's perfect for people with really small balance IRAs, or, everybody's got that one 401k that they left an employer 10 years ago and they never did anything with. That's an opportunity to invest those types of funds.
Well, let's talk about starting. So Who was a young Heather? I mean, young Heather, was she into investments, family into investments?
It's an interesting story. So my parents were always successful with real estate. I did see that there was a path to, creating wealth for yourself and your family through real estate. My mom and dad did well buying real estate, selling it here and there. And then I was a college soccer player and thought I wanted to be a teacher, which is so funny because my kids can attest that I would have probably been the worst teacher ever. They're like, you were terrible helping us with homework. And so went to college, got my teaching degree, and discovered very quick that that was not my path and my niche, and had a friend in the private money industry. And he's like, hey, come on board with me. You have a little bit of sales experience. I'm like, I don't even know what private money is. When I grew up, I thought you went to the bank to buy real estate, you got a mortgage, and those were your only options. And you worked with your financial advisor to invest your capital. My mind was blown. I started working for a private lender. I had no idea. I didn't know that if you had a good deal, there were private lenders out there that would fund your deal, and you didn't have to jump through all the hoops that a bank requires you to. You could fund quicker. I had no idea that you could invest capital in real estate in smaller increments through the private lending world. And then my husband and I got really active in investing in real estate. We tried out the fix and flip. We thought we were like Chip and Joanna. I'll just tell you, it wasn't that glamorous. I hated it. And we quickly decided that maybe the rental path was better for us to deploy our capital and, build our portfolio up. And, 20 years later, here I am continuing to help my clients and their families invest their capital and just create wealth for themselves. So I had someone the other day on a podcast say, but you are an educator. You are a teacher. I guess I never thought of it that way. But I guess maybe my path just took a little bit different direction. I'm not educating kids. I'm educating people, the path to financial freedom.
Well, a couple of things I want to jump back into with your parents. So you said they had some success with it. So
Yep.
Were they buying and holding? Were they buying, renovating, and flipping? What were they doing?
So my parents focus more on land.
Okay.
We are in a beautiful part of the country. We're in the Pacific Northwest, state of Washington, state of Idaho. And my dad and mom did very well buying land and reselling it. So they weren't really developing it. They would buy land, sit on it, lake lots, that here are very desirable. And then also grew their wealth through buying homes and living in them for a period of time, eliminating capital gains and then reselling and moving up in the real estate world.
Now, okay, then you and your husband get into the private equity. You start hearing about it. Fix and flips that you started out with.
Yep.
What pushed you to go into buy and hold? I mean, were you having negative experiences? It was not going as planned. What was going wrong there?
Well, I think the first mistake we made with our first one is, my husband came from a construction background. So probably like every other real estate investor, you get into it and you think, I'm not paying someone to do that. We're going to do that ourselves. So I'm managing a fund, raising capital 5 days a week. And at nights and on weekends, I'm laying tile and demoing a house because we're too cheap to pay someone else to do it. And so we did 3 of them. And, I think the mistake we made is trying to do it ourselves. We both have careers and don't have the time to be hands-on as we were. And then realized that for us, the rental product was a better option for us, really just to we want to leave a legacy for our kids. We've included our 2 boys in this process and educated them about real estate. But for us, our goal is to leave a portfolio of rentals. And when we're gone, if they choose to continue to manage those, that's great. If they don't, at least they have some assets and, some of the benefits of depreciation and things like that better fit our portfolio is really kind of how we ended up down the rental path.
And then so private equity, you were already raising funds separately from what you were doing. You're raising for someone else?
I worked for another private lender at that time, and I had my securities license. And what we did was we sold notes. So we would internally fund it with the capital that the company had, and then I would sell notes or first lien positions. We didn't really have funds per se at that company. And then when I came on board here, it's a very clunky process. As a private lender, you're trying to match people with capital that want to fund deals with borrowers and real estate investors that need capital, right? You've got on one end of it a broker and a borrower that's itching to close. They got a purchase and sale that's about to expire. It's gone through underwriting, and I'm dialing for dollars on the other end saying, hey, Vinny, I've got a deal. It's out of Texas. You want to fund this? Yeah, I'm interested. Okay. And this guy might be using IRA funds, which is complicated and takes time. So what we discovered 10 years ago was there's got to be a better way to do this. There's got to be a better way to service our borrowers and our brokers, and help solve their problem, which is funding. And there's got to be a better way to give our investors with the capital more time to make a decision if they want to move forward. So that's when we opened up our first fund, because again, it's a clunky process, right? You're trying to close quick, get money transferred in. And so the fund gives us the ability to close quick for our borrowers and brokers and accomplish what they're trying to do, close the deal, right? And then on the other side of it, our note buyers have a little bit more time to do their due diligence, decide if they want to move forward with the note they're buying. And then we were able to also service our really passive clients that said, I don't want to buy a note. I don't want to deal with foreclosing if they don't pay. I want to put my money to work. I want to get my quarterly earnings, and I want to be hands off. So we always try to service everybody, and everybody's got something they're trying to accomplish, right? Maybe it's yield, maybe it's funding. And so that's really where we segued into starting to raise capital into our equity funds, and then continue to sell the notes to replenish the fund's capital.
Let me get this straight. So the private equity, private lender that you're working with, was that a salary position?
It was actually salary and bonused.
Okay. So somewhat kind of steady right there. And then when did the transition of co-founding Secured Investment Corp come about? Because I mean, in that case, you're probably not getting any kind of salary. That's probably mostly commission off the start, I would guess.
Well, actually, with an equity fund, it's interesting. You cannot commission or bonus any employee unless you have a securities license, meaning you're a licensed broker dealer. And so the way that we're bonused is actually based off the performance of the fund. So that is a big motivating factor for us, right? As an organization, as a team, like that fund needs to be profitable, or we're not getting anything. We pay out what's called a preferred rate of return, meaning the first 9% goes to our fund members, and then we split profit above and beyond that. So it continues to make us motivated as an organization, as a team, to get those yields above that 9% hurdle rate, right? And so that's where we become profitable. I mean, we do get paid what's called a management fee, which is very typical for a fund, but we have a staff of 100 employees here. There's a lot of working parts to managing an equity fund. And so typically a management fee barely scrapes the surface for, costs.
Well, let's not talk about it now, but let's talk about when you first started. I mean, when you first started, it was you, two other people. I mean, did you bring on a full staff when you started, or what did that look like when you first opened the doors?
So we had about 20 employees, because as an equity fund, raising capital is half of your challenge. The other challenge you have is deploying the capital, right? You can raise as much money as you want, but if you can't deploy that capital, you're in big problems. So we had a team of a couple guys that were what we would consider like a loan officer or originators. So they're out finding the deals. They're finding the guys that want to borrow money. We've got one underwriter. We had one person that was an underwriter and also serviced the notes so that he would make sure that they made their payments. And all in, had about 20 employees, and now we're over 100. So we have an origination team in-house of about 25 people. We also have remote employees. My department alone that raises capital and works with investors is 6 people. We have a servicing department of 8 people, and it kind of just goes on from there. So we have, over the last 10 years, we were very small when we started, and we have grown. And, in order to scale and grow, you have to add staff and be able to, spend a little money for support staff, and also for, people that produce and originate and raise capital.
Well, let's go back to that beginning. We're 20 people right there. I mean, most people have had having the podcast, right? They don't have the startup capital to build something, so they're usually bootstrapping it and kind of slowly working their way. And so it's an easier transition for the hiring process to learn how to hire, right? In your situation, where you're bringing on 20 people off the start, what was your process like of finding the right people in this fit? Did someone have a background in hiring? Did you have a list of names that you worked with in the past? Were you poaching from other companies? What was that process looking like?
All of the above. I mean, the best person that you can hire is someone already working somewhere, right? In my opinion. But a lot of it was, and I ended up, my path to this company was because I knew someone that worked here that worked with me previously at the past employer. So it's interesting. The private money industry is a very unique industry. It's not well known, whether that's from an origination standpoint or servicing or underwriting. It's not traditional banking. And it's just very unique. So a lot of the people that we started with we all knew each other in the industry. Hey, I know this guy, he can underwrite. Great. And we all wore multiple hats. I mean, to be honest, I originated loans, I sold loans, I raised money, and I serviced. Everybody wore multiple hats within this organization. And as you grow, you start bringing other people in. I will tell you, we have never leveraged this company. We didn't borrow money to start it. We've always worked off of a cash basis. So you eat what you kill, right? Like, we weren't hiring and leasing buildings unless we could afford it, and we were producing that revenue as a company. So I think that's really important. Back probably 8 years ago, we almost partnered with Wall Street, with a company out of Wall Street that was a private equity firm. And honestly, it was the best thing we ever did not doing that, because we have controlled everything. We don't have a board, and we're not answering to investors. And I think that has been a big reason we've continued to be successful, and we've continued to be able to grow.
What do you think has been the restraints or the biggest hurdle you've had to work through in kind of building the company from 20 people to 100?
Yeah, for us right now, it's finding the right people. And you look at a company like ours, and some people will say, wow, they have a revolving door. I mean, the core people have always been here. And part of that is our location. We're in northern Idaho. It's not, and we also want people local. We don't love remote work because we want them to have the company culture here. We've worked hard to create this culture, and it's extremely important for us to have our staff in-house. And so I think the biggest challenge is hiring and finding the right people. Again, one, because it's location, and two, it's such a unique industry. So personally, I'd rather find the right person that's driven, motivated, organized, coachable than somebody with, a background in this industry, because at least you can coach them the way you want to. And so, we've had to cut bait with people very quickly, realizing that they're not the right fit for the company. Which never goes well, right? People are disgruntled and they get online and complain. But I'd say our biggest challenge is finding the right team members to support our growth and our vision. But you have to be willing as a founder and as an organization to be able to say, this isn't the right person, they're not the right fit, and move on quick. Hire right, You
talk about the idea of the revolving door. I mean, so it sounds like that has been kind of the hurdle. So what's the process, or how has the process changed in the hiring, and how has the process changed in the firing? Because it sounds like it's pretty quick in the firing now.
Well, and I think the thing to probably explain a little bit about is, you have, management executives, and then support staff, and then also salespeople. We're a sales company, right? Like not only do we originate, which is a sales position, but we also sell real estate education. So when I speak to that, it's probably more focused around the sales staff, because it's a hard sales. They're on the phone. They're expected to make 4 hours of talk time a day and 75 calls a day. So the revolving door comment is more focused around that staff. I feel like we've done a really good job building our support staff. But we hire slower now, and we probably fire quicker, trying to identify quickly and not wasting 6 months of our time and their time knowing that they're not the right fit. The other thing is training. We've changed a lot of our training. We're a overwhelming company to walk into. There's a lot of working parts. We've got 2 bullpens, one with the origination team, one with our sales team, on the phones all the time. So we hire only once a month. So everybody starts on the first Monday of the month. And we now do a 4-day orientation. And what we have found is when these new hires come on board together, they have some camaraderie. Otherwise they're walking into 100 employees. They feel like just a number. So we have found that doing what we call a new hire class and a 4-day, really intense, focused orientation with just those team members has really helped, because now they've made some relationships. They have other people that they started with. That's been a big game changer for us, and has helped with retention also. And then having very specific training modules, especially for our sales staff, not throwing them on the phone the first week they're here. They don't even get on the phones for like 2 to 3 weeks. They actually sit and they will job shadow another salesperson that's been here, and they'll listen to their phone calls. So I think probably just better preparing them to be successful rather than, here you go, here's a phone, let's start dialing.
Where do you see the company going in the next 5 years?
We have big goals. We have big goals for capital raise. We continue to be very successful with that, and continue to be able to provide our investors with great earnings on their investments. We have goals to be one of the biggest private money lenders out there, and I don't doubt that we'll do that. We're closing 45 to 50 loans a month. And then on the real estate education side of things, it was a game changer with COVID. A lot of companies closed. They, at that time before COVID hit, we were putting on 2-3 live events a month all over the United States. When COVID hit, that's like 70% of our company revenue. We weren't sure what was going to happen. We quickly pivoted and we went live streaming, and now we do 3 to 4 events a week. And yeah, it has changed. Sometimes you think that just because you've always done it one way, that's the best way to do it. And when you're forced to make changes like that, a lot of times you realize as an organization, wow, that wasn't the best way to do that. We actually can be more profitable. We can have a broader reach out there being live streamed, and people like it better. They don't have to travel to Georgia to see our event over a weekend when they've worked all week. They can stay at home. So I think that as a real estate education company in that space, we're going to see huge growth too.
Where do you see the market going? Do you see the market changing? Do you see the market affecting you guys in any sort of way?
So we do see it changing. It is changing everywhere, specifically in our location, which we're a nationwide lender. So we're not just focused in Washington and Idaho. But we're seeing the market soften. Homes are taking a little bit longer to sell. The other thing is, as a real estate investment company, we are always looking at different strategies. I think that's one of the things is you can't pigeonhole yourself to saying, well, we only fix and flip. That's all we do. Because just because fix and flip strategies were profitable 3 years ago doesn't mean that that's the case now. Homes are more expensive, interest rates are going up, they're taking longer to sell. So we're actually really focusing around long-term rentals and short-term rentals, VRBOs, things like that. And as a real estate investor, you have to be able to pivot with the market. And we see a huge opportunity in the rental market right now, especially in commercial. We just bought a 22-unit apartment complex in the state of Washington that is a great cash flowing property. We'll sit on that for 5 years and then reassess it and maybe sell it, down the road. And we continue to buy single family. But we think that the deals are drying up. They're not as many of them, and they're not quite as profitable as they were even a couple of years ago, 3 years ago. So, we see the market softening, but everybody still needs a place to live. And, the real estate market has always been a great place to be, especially in inflationary times like we are now.
Being that you guys assist all across the United States,
Mm-hmm.
how much flexibility or how much say does the underwriter get in knowing the different communities from state to state, community to community? And as those markets are trending, is it support that you're providing? Is there a group that you just strictly on data that provides that to the underwriter, or how does that look?
We use multiple different tools. A lot of it's internal. We identify different markets that are distressed, and we actually have several that we lower our maximum loan to value on. we don't want to be the lender that says, hey, we don't lend in Chicago and Cook County, and we don't lend in Detroit. We want to say, hey, we're the lender that'll do it, but these are now our parameters, right? And so our maximum loan to value nationwide is 70%. But there are very specific counties, and it's hard to say it's a state thing or, typically what we find is it's county. So Cuyahoga County, Ohio, maximum LTV is 50%. Detroit, 50%, Cook County in Illinois. So we're always looking at that. I mean, we use a lot of third-party tools. We use appraisals and these other new hybrid evaluation tools, but it's really being hands-on through underwriting. There are times that we've had deals come to us and the appraisal says one thing and we're like, absolutely not. That house is not worth that. So I don't know that it's an automated process. It's really having an educated and trained underwriting staff. And then we have what's called lender committee. We meet twice a week. And if the underwriter or the second person that double checks the file has any trepidations, it goes to lender committee and we all sit in there and we discuss it. I think companies have got away from that personal side and, because it's a moving target, it changes constantly. So, and then we use things like inspectors that go out because a lot of our clients are rehabbing properties. There's been times where we get a rehab bid and we're saying, there's no way this guy's rehabbing this for $20,000. We'll send an inspector out and say, hey, what do you think? So again, it circles back to having that personal touch on those files, because the reality is, if we underwrite a bad file, we're going to be dealing with it through servicing. You're going to have a borrower that doesn't have enough money, can't get it done, can't get it sold, defaulting on a loan. We're going to end up dealing with it anyway. So it's a lot easier to nip it at the beginning. And the other thing is, we want to set our borrowers up for success. We are not that lender that's out there to just, charge a bunch of origination fees and get our investors the capital or the earnings that they're looking for. We want our borrowers to be successful. And we've had deals that we've said, hey, you're not going to make any money on this. Why are you, spending all this upfront cost, paying these closing costs? We pride ourselves on our borrowers making a good yield, and then also our investors and making sure that our funds are well secured. So we'll turn deals down because we don't feel like it's a good deal for the borrower, even though we could have made a 5-point origination fee. That's not what we're interested in. We want repeat clients coming back to us over and over.
Makes sense. Well, thank you, Heather, for being here today. If anyone's listening and they're looking to finding more information about private lending, actually putting some of their money to work, what's the best way of getting more information?
Yeah, so you can always visit our website at Secured Investment Corp. So securedinvestmentcorp.com. We have information on there about our individual notes that we sell. We've got information on there about our real estate funds that people can invest in. And again, that's the fund that has as little as $1,000 minimum. And then they can schedule an appointment to talk with me and my team. There's a link on there that they can get more info and then schedule a 15-minute consultation. So yeah, just visit our website, securedinvestmentcorp.com. If they're looking for funding, if you're an active real estate investor, you can visit our website at Kogo Capital. It's COGO Capital.
And that is in the show notes. Heather, I'm going to put one last question.
Okay.
If you could give any advice to, I guess, yourself, you and your husband, when you were first starting to invest, fix and flip, and I know you already threw out the advice of don't do the construction yourself. Is there any other piece of advice that you could provide to your younger self?
I would have started investing in real estate sooner. I really think that a lot of people feel like you have to have a ton of capital to start doing it. You don't. You have to have the right deal. If you have a good deal, the funding is there. And I wish in hindsight that we would have started a lot earlier than we did.
Yeah. Well, you guys, if you've listened to the Road to Growth, there's so many different investment opportunities out there, especially for other realtors. So much investment opportunities out there. I've had people on this podcast that do the land, where they buy the land and they basically sell it out. They do the mailers, golden letters. If there's opportunity, if you see a house that's run down and you know the owner, instead of passing on to someone else, you might want to look at doing it yourself and find that funds.
Absolutely.
Thank you again, Heather, for being here. Everyone, please subscribe, please share, go in the show notes and find Heather.
Thanks for
Bye-bye.
having me.